Welcome to the Daily Update, where I'll go over the action in the market for Monday, April 10th, and then we'll see how things look for Tuesday, April 11th. We had a slight update. When we look at the intraday chart, you'll notice that the price patterns for Thursday were pretty similar to the price patterns that we saw on Monday. We started lower and then inched our way back higher. So overall, even though it wasn't much of an update, it was still positive in how things played out. We're getting to the point now where we continue to be somewhat short-term overbought as well as some intermediate-term overbought. There are warning signs that we need to heed. That never changes. There are always things to be concerned about, but we'll go back and evaluate things and see where we come out overall. Before I get started, I have a couple of things to go through. From April 22nd through May 11th, I will be traveling. I intend to do at least the daily videos. I do have a podcast that's available to you, but it's a carbon copy of what you're seeing right now. There's PDFs in the description for each video as well as in each podcast. I have a private Facebook group that you're welcome to join. I do have a new poll, and I'll be doing that every week, and that stays up there for the entire week, and then I'll go over that in the weekly video. Another thing that I want to throw out there, and please feel free to leave a comment or send me an email. I used to put chapters in each section of the video. If you think that is helpful, I can add those. It takes me a little extra time to do that, but I can put those in if you desire that. And I also used to do some zooming in on charts, especially when it's a big chart or we have a lot of information in one chart. Sometimes it's helpful to zoom in. That does take a little extra time, but if you find that will be helpful, please let me know. Also, you may have noticed that I don't have the best audio at all. I really try to work hard to make the audio quality good. But one thing that really bothers me is when I go from slide to slide, you hear this boom, boom, boom. I'm trying to fix that. When I go on this trip, I'll be able to order some things from Amazon that I'm not able to receive right now. And one of those things, I hope, will take care of some of the audio issues. All right, let's go back and talk about what happened. Right at the open, we had a gap lower open, with prices falling below S1. And that was the same as what we saw on Thursday. The only thing that changed was the S1 level at 4,081. As the day went on, prices fell back below S1 before rebounding back above the daily pivot at 4,094. We went up to the unchanged level and then closed positive above 4,100. We ended up closing up just 0.1%, but it was still a positive day. Volume continues to be below average, and that is a concern, especially when we're going higher. Our technicals are still positive overall. There are some things to be concerned about that I'll go through in the video. Because of the inflation and interest rate scenario, we're going to get CPI and PPI and retail sales coming out this week. That's going to give us some real insight as to what's happening on the inflation front. We're still wondering, is there still going to be some more banking news that comes out to cause this crisis to go on further? Here's the intraday chart showing how we gapped lower below S1, bounced around there for a little bit, came back up, fell back down through S1 again. Then from there, we saw some really powerful up moves above the daily pivot, and then going into the close, we just barely inched above the unchanged level. And if you look at Thursday's action and Monday's action, they're very similar, showing initial weakness. These are the amateurs who open the market and a strong close. These are professionals who close the market. Here's large cap growth versus value, showing how they inched back higher overall. One thing to be a little concerned about, large cap growth was down where large cap value was up. With the mid caps, growth was up just a little bit more, as well as with the small caps. Here's the SPY 10-minute chart. We opened on Sunday, drifting a little bit lower, and then the overnight session started. It initially started out as positive, and then we saw a real big drop in the futures right before the open. That carried over into the open, but then we spent the rest of the day clawing back to end positive. We've drifted up higher, and now we're going a little bit more sideways in the initial overnight session. What are some comments that we can make? The S&P regained the 4,100 level again. Volume continues to be below average. The anchored moving average from the all-time high is providing support, and I have a chart to show you that. The NASDAQ and NASDAQ 100 closed negative, down not all that much, but still negative, and they've been providing a lot of strength lately. Small and mid caps, which have been weak lately, were strong in Monday's session. On a short-term basis, we have the Stochc RSI, Stochastics, and Williams Percent R, which are extreme positive. Intermediate term, we have the TTM squeeze getting kind of high there, the PMO study, the Chaikin oscillator, and the ultimate oscillator. And on a long-term basis, we have the 10-day moving average of the S&P 500 new highs against the new lows, and I'll show you that chart. The dollar was up and interest rates were also up. The home builders' negative divergence, that's still happening right now. It's still on the books. The 30 to the 5 has gone back to being normal with all of our other yield curves still inverted. Sentiment was unchanged at 60. We're still positive overall. And our trend is positive. The green line is on top, but it's coming down, so it's weakening. On the other hand, it's still above the moving average. So in that sense, it's strengthening. And I know that kind of goes against logic there, but I'll show you the chart. We're still below 20, so overall we're not showing a real strong trend right now. I've changed our bias to positive with the slight update to mixed because the market's still trying to figure out what it wants to do, especially on lower than average volume, and I've kept our momentum at mixed. The economic reports, I'm going back to last Friday when we had the employment situation report. Non-farm payrolls came in at 236,000, a little bit less than the 239,000 that they had expected. Last time, it came in much higher at 326,000. The non-farm private payrolls came in at 189,000. They expected a lot more than that at 213,000, and it's also down from last time at 266,000. Are we starting to see some weakness in the employment situation? However, the unemployment rate ticked down a little bit from 3.6 to 3.5. The average work week actually ticked down a little bit to 34.4, where they had expected it to be at 35.5, the same as last time. Then we had wholesale inventories, which came out up 0.1%. They expected them to be up 0.2%. Last time they were down 0.6%. First, looking at some Isabel net charts. This chart looks at the drawdowns during recessions. You might just want to pause and look at this. We don't know really to take an average or look at this and get some insight from it, but it's just kind of interesting information. Then we're looking at the mega cap growth. The earnings are this dark blue line here where they had dropped off. Now the forecasts are that they're going to be going back up to the overall trend and possibly even going above that and then coming back down and then going back up. And the consensus is this orange line with what they think will happen. Now we're seeing a disconnect between consensus forecasts and actual reports when they come out, and they're kind of off kilter with each other right now, and something's going to have to give in that whole arena when it comes to earnings and earnings forecasts. This is kind of a hopeful chart here where it says a weaker labor market allows the Fed to cut aggressively. That's what the market is banking on. For almost a year now, the markets have tried to find any reason whatsoever that the Fed is going to be able to cut rates. And they look at anything they can. The market goes up. The Fed comes out, says something, spoils the party. The market tanks. And then they immediately start coming up with the next scenario, thinking that the Fed is going to pivot or they're going to start lowering rates at some point. And this chart is no exception. These are the job openings, which we have seen starting to come down. We're not really seeing that drastic of a change in the employment situation yet. It has weakened from the previous month. Now we have to see what's going to happen next month. What's going to happen with weekly jobless claims? What's going to happen with continuous claims? And those other things that we all take together to say, okay, the employment situation is starting to show some weakness. And this chart would suggest that if this continues to go down, the Fed may be done raising interest rates. Looking at Bitcoin here, which we're comparing the production cost with the market price. Right before I started recording, I glanced at Bitcoin. It's up back over 30,000 right now. But there's still a spread between what the market is willing to pay and the blue line, which is what does it cost to produce Bitcoins. Then here it says the S&P 500 sectors announced buybacks. Most of the buybacks are happening in the energy sector, followed by financials, then communication, then IT, and it just goes on down the line. This is seen as a sign of a positive environment. When a company is willing to go out and buy back its own shares, that means that there are fewer shares on the market. That decreases the supply and increases the demand and has some real support for a stock price. This is the ISM. When it's under 45, that means we potentially are heading into a recession. Right now, we're at 46.3. Edward Yardeni had an interesting chart. The red line is just the actual forward PE ratio, which currently is at about 18 times. So it's under 20, but above 15. And then just some projections out. If we get up to a PE ratio of 24, where will the S&P be at? And if we go all the way down to 10, where the S&P would be at that time. Michael J. Kramer had some interesting charts over the weekend on Twitter. He posted this chart of the S&P. Could this be a head and shoulders top? We have the left shoulder, the head, and then potentially the right shoulder. And then if we drop down below the previous low set in March, these are the different levels that he sees things potentially falling to. He had another chart showing the 40-day cycle where we're coming up at the top now and starting to go back down. Will that eventually put some stress on the S&P 500? Another one compares the NASDAQ with 2022, that's the blue line, with 2023, where we're having a tendency to follow along with what has already happened. Just kind of interesting, but I don't make decisions based on this. He also made a post from Bloomberg Terminal showing the S&P 500 EPS estimates and how they've just been coming down overall. But then we have other data to suggest that earnings estimates are going up. So we're seeing a real contradiction of different flows of information. Getting into our own analysis, the Ulcer Index is showing that the market is still rather complacent, not a lot of fear. The VIX ticked up just slightly even though we had an up day. The market didn't go positive until right at the close. The equity put call ratio, after spiking up and coming back down, that has already provided some support to stocks. Will that continue? Looking at another fear gauge showing this blue line where we've been tending to go down as far as fear is concerned. Here's another fear gauge where it's just chopping sideways after spiking up when we had a few down days, and it's been coming down since then. This chart of the high beta stocks continues to suggest that we are more in a risk-off type of an environment. Here's looking at the trend, where the green line is on top, but it is declining. That's what I say when the positive part of this indicator is showing some weakness. Then I say we're strengthening in the trend because we're above the moving average. So that's why it looks like it's a contradiction there. But we're still below 20 overall. However, we are starting to get a little bit stronger. Looking at the daily chart, we do have some overhead resistance if we continue to go up with the S&P. And we also have previous highs that may act as previous resistance as well. If we continue to go up, we might see this line of previous highs, which would be a horizontal line, and this upward sloping trend line interject just about the time we get there. So that could be some pretty significant overhead resistance. So we're looking at the previous highs around the 4175 to 4180 level-ish. On the bottom, you see where volume continues to drop off. We're still in the second standard deviation of price, so we're not going up too far too fast, but we are maintaining a positive stance. The Stochk RSI has ticked back up slightly, so that's extreme positive. The Williams percent R remains extreme positive. The short-term stochastic still extreme positive, as is the intermediate-term stochastic. We're also extreme with the longer-term stochastic, and this is starting to roll over a bit. The force index is still positive, even though it declined slightly. We're above all plotted moving averages. We have dots underneath on the parabolic SAR chart. And if you didn't watch the weekly video, we saw a dot drawn underneath the weekly bar for the first time in quite a while. So now we're seeing confirmation on a higher time frame, the weekly charts, and then we've been seeing this already on the daily charts. This is a warning sign. The Swinland trading oscillator based on price and volume, they're still positive, but both are declining. Chaikin oscillator getting extreme positive. The vortex, even though the green line is declining, we are still positive. The ultimate oscillator is extreme positive. This is another warning sign. If we were really going up strong, we would see this ratio going up, and it's actually going down. The S&P is not outperforming utilities on a ratio basis. Ichimoku cloud still above this green cloud, which if we fall may provide some support at some point. The PMOs that are rising is turning back up. We're still extreme positive with the buy signals and showing improvement with the percent of PMOs above zero. The bullish percent index just ticked up slightly. It's been chopping sideways, but we're still above 50 and advancing, so it remains positive. And the broader range BPI actually ticked down slightly. The Chaikin money flow really spiked up quite a bit. We have to keep watching this. If we continue to go up with these green bars, will we get to an extreme positive reading? The balance of power ticked down slightly, but it's still positive since it's above the dashed line. CMB composite, after giving us an extreme positive reading, is now dropping back down. The TTM squeeze, again, getting to a point where it could get rather extreme. Go, no go remains positive with the dark blue lines. And here's an anchored moving average showing how going back to the all-time high, this moving average is providing support. Here's a longer term look, but this is a line chart, so it doesn't have the bar for the intraday data. but we're still maintaining price above this anchored moving average. Our fib levels, we have some resistance at the 41.25 level. If we continue to fall, we're going back down to the 4,000 level before we get to support. Longer term, we also have more resistance at the 41.55 level. And then we want to watch this previous high that we set. Longer term, we have overhead resistance at the 42.16 level. If we continue to fall, we're looking at the 40.20 level. And here's the quadrant chart, where we also have overhead resistance going back almost to these highs that were set earlier in the year. The equal weight, even though it's showing some improvement, is still underperforming the rest of the S&P 500. And this also bears that out, where the big stocks are really outperforming the smaller stocks. The Elder Impulse system for the S&P remains neutral. McClellan oscillators turning back up, so that's positive. The broader range McClellan oscillators above zero and advancing, that's positive. The summation index based on price and volume continue to be positive. Then here's another look at Dow theory. We're seeing a little bit of a negative divergence here, where the S&P 500, which is on top, is still staying above this blue line that I drew here, where the NASDAQ has not broken above that blue line yet. Just a little thing to be aware of, because we're also watching for a potential double top in the NASDAQ. The new highs continue to advance with the 5 period and the 10 period. The advanced decline line, still seeing this negative divergence between price and volume, but we continue to be positive. Here's another chart I haven't shown in a while, just showing the NYSE advanced decline line and how we're trending higher with this. The advanced decline ratio has turned back up and is above zero, so both of those lines are positive. Accumulation distribution continues to advance, but it's getting kind of far away from this moving average, whereas volume continues to drop off. The money flow ticked down a little bit, but is still above 50. On balance, volume continues to be positive with a rising moving average. The KG chart is positive, but we're pointed down, so that's positive with a negative slant, where the Renko chart is looking positive, and the 3-line break is still looking positive. The boom indicator, after giving us an extreme reading, has ticked back down, but we're still positive overall. We're also positive with the 50 and 200 moving averages. The ratio between the S&P and the financials is still showing a real breakdown, and we're seeing a death cross with this ratio. Then when we compare the regional banking ETF to the financial sector, it ticked back up slightly, but still showing an awful lot of weakness. The broader range look at the advanced decline line. We're coming back up to the moving average with the NYSE. We're still above it with the S&P 500. We crossed back above it with the mid caps. The small caps, even though they're showing some improvement, still remain below the moving average. The Dow is still above its 50-period moving average and pretty much chopping sideways. The diamonds continue to be neutral. The NASDAQ, here's that double top we're looking at right here. If we get set to go higher, we're looking at about the 12,250 level. The NASDAQ 100 did break out above previous highs. Can it break out above more recent highs? The Elder Impulse for the Qs remains neutral. Here's the NASDAQ 100. If we start to fall, we'll be looking at the 12,868 level for support. And then we have more resistance, but it's quite a bit higher than where we're at right now. Here's a chart that I've shown before. This is going back to the all-time high and then placing an anchored moving average on the NASDAQ 100, showing how we're bouncing into this level, and we're just about at that level now. Can we break through that? Or is this going to provide resistance and we're going to turn and start to go down? The micro caps had a pretty good day. They did not set a new 52-week low. The small caps had a good day, up 1.20%. The Russell showing a little bit of improvement, but we're still below the 250-period moving averages. The RSI is right on 50. The MACD continues to be positive, where the small caps have now switched to positive after being negative. The small cap ratio to the S&P, after really breaking down, showed a bit of an improvement, where the mid caps were able to get back above their 200-day moving average, so that's positive. And the Elder Impulse is also switched to positive for the mid caps. The home builders, keeping an eye on this. We still have a valid signal when this ratio was going in opposite directions, even though it's really improving now. Will this put some resistance on the market? The Copic curve continues to generate a buy signal, and the praying bottom fisher continues to also generate a buy signal. Here's a chart that I usually only cover in the intermarket analysis video, but I created these charts over the weekend, so I just wanted to show them here. Some of you do invest in gold and silver. Up on top, this is a line chart of gold and how it's been doing. Here's the silver chart and how it's been doing. On the bottom, you just see that there's a real strong correlation between gold and silver. This is the gold to silver ratio. When it's going up, that means gold is outperforming. When it's going down, that means silver is outperforming. But then we compare this to the dollar. So when the dollar index is going up, gold tends to outperform silver. When it's going down, silver outperforms gold. But note, they can both be in an uptrend. And some of you don't want to jockey back and forth, and that's fine. We're using this chart just to gain some insight as to what's going on. The dollar going down usually benefits stocks, and that's what we're keeping an eye on because the market likes a cheaper dollar. But this can also give us some insight as to what's happening in the precious metals market. Looking at yields, we ticked back above 3.4 on the 10-year, where bond prices fell slightly. Then our long-term analysis, the MACD is still above zero and advancing. So longer term, it's looking like this breakout above the trend line ended up being for real. Then the updates of possible positive scenarios. We're getting a little extreme here with the 10-day average of the S&P 500 highs minus the lows. Now, this isn't reason to freak out. We can go up here and then stay pegged up at this upper band for a long time. So you could take this as positive, showing that there's some real strength going on. Or you can be a little bit gun shy of this, saying that we're going extreme and we may drop back down. I tend to say this is looking more positive right now until we have other evidence that things are turning. Then looking at the 19-day exponential moving average of the advanced decline ratio, after getting extreme, this is falling back down but tick back up slightly based on price as well as volume. Then this is another thing. This is an indicator I used to use a long time ago by a guy named Martin Zweig or Marty Zweig. Some of the first books that I ever read, he wrote, and he used to be a staple on Wall Street Week, which appeared on PBS for years and years and years, with a guy named Rukeyser, if you remember him. He came up with this breadth thrust indicator based on the NYSE that when we hit a real low reading below 0.4, and then within 10 days, we thrust up. That tends to be the start of some kind of a bull market. So what we do is we take the 10-day exponential moving average of advancing stocks, then we divide that by the sum of advancing plus declining stocks. This generates a signal when we go below 0.4, and then we climb back up above 0.615 within a 10-day period. But this could be really positive. Never mind necessarily that it's now fallen back down. This signal has already been generated, and until it shows a lot more weakness, we could still use this as a valid signal. This also came from a Twitter post which shows pretty much the same thing and when these signals were generated and then what the returns were 1 month, 3 month, 6 month, 12 month, going out from there. Feel free to pause and look at that, but it tends to be pretty positive for the market. Then looking at the wide range of highs minus the lows and taking a 5-period simple moving average, we're still below zero overall, so that's a warning sign. Looking at our ratios between growth and value, the Qs are still above the moving average compared to the S&P. Discretionary is turning back up, but below the moving average, where large cap growth versus large cap value is still above the moving average. Then our growth to value ratios with the large caps, mid caps, still below the moving average, small caps turning back up slightly. Then looking at our 50-period exponential moving average of the new highs minus the new lows, we're still above zero because the indicator is above zero even though it's fallen a little bit. The 2-year Treasury yield, after spiking up and coming back down, that has already provided some support to stocks. Will that continue to do so? Our staples ratio, still wondering if these two spikes here could be a spike before we really start to head lower, and that can give some really good support to the S&P. So what's our outlook for Tuesday? The CPI is due out on Wednesday, the PPI on Thursday, retail sales on Friday. Heavy week. Earnings season is coming up, and the large banks are going to be the first to report those earnings. The technicals are positive, and we have short and somewhat intermediate term overbought conditions. On Tuesday, we have the NFIB Small Business Optimism Index coming out. The whole list of geopolitical events with inflation and interest rates being at the top, and then in the background wondering about any banking problem. Looking at the Stock Traders Almanac statistics for Tuesday, April 11th, we tend to be positive overall, with the Dow being up 61.9% of the time. The S&P and NASDAQ are up 71.4% of the time. For the month, we still see a positive April. Then the next slide just shows all of the yearly things that we look at and talk about from time to time. Here's the chart showing the green line, and we're supposedly in that period right now. Here's the gray line in that period. Here's another gray line, and we're in that period. Will we see that happen with price? I think we're on the 7th trading day of the month, but we tend to be fairly positive overall with the green dash line for the S&P. Our scenarios. Can't go with the down one because things are looking pretty positive, but we are short-term and intermediate-term overbought. We're also seeing the green line coming down on the ADX. Can't really go with the positive one unless you're more aggressive because the ADX is still below 20. It's positive, but it is getting weaker. The warning signs that we need to be careful of. Volume remains below average. The S&P is short and becoming intermediate-term overbought. The VIX is still really low. When the VIX is low, it's time to go. The S&P is underperforming utilities, and that continues. Small caps are underperforming, but they did improve on Monday. The Nasdaq may be declining from a double top. We're keeping an eye on that. The home builders registered that negative divergence, which is still in play, so we want to keep an eye on that. And then earnings season is coming up, and the banks are going to be coming out first. If their earnings are really weak, that could really send the market lower and give some real negativity to the overall climate. Our conclusion, the S&P is positive, but on the short term and somewhat in the intermediate term is overbought. So short term we're positive, intermediate term positive, but slightly overbought. Long term, we're still above that 200-day moving average, and we had a recent golden cross. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.